All right, well, welcome, ladies and gentlemen, to another UK housing market update. I know it's been over 3 months since I last did one, around about the same time since I actually left the UK, but I haven't forgotten about all of you. So many people asking, am I going to continue to do UK videos whilst I'm no longer in the UK? And yes, I will. I just won't be doing as many as I used to do. But today will be an in-depth housing market video update for you. So I hope you enjoy it. So I've got to start with the most shocking development that I've seen in the UK housing market. And honestly, when I first heard about this, I thought someone had made it up. I had to really do a lot of research to actually find out if this was true. There weren't many articles, and some of the articles that did come out were actually taken down. Very suspicious if you ask me. But let me show you what I'm talking about here. Here we go. Lloyds Bank to become a private landlord. Initiative will involve buying and renting out new and existing housing stock across the UK. I don't even know what to say to this. Let's have a look at this then. Let's unpack this a little bit. So Lloyds Banking Group is planning to become a large private landlord as it searches for new sources of revenue in an era of low interest rates, according to documents seen by the Financial Times and people familiar with its plans. I've highlighted this because I've heard this over and over again. I've seen it reading history. The initiative, known internally as Project Generation, will involve buying and renting out new and existing housing stock across the UK and aims to have its first tenants by the end of this year. This is morally wrong, and I won't even get into the finances of it, but this is morally wrong because this means in a housing market where you as a family or a couple or as an individual are trying to buy your first house, for example, or you wanting to move house at some point in the future and get a new home, you are no longer competing with, Mr. Jones or Mrs. Smith down the road. You're now competing with banks who have unlimited resources because they create money. 97% of all currency is actually created. So this is new currency. It's actually created by commercial banks. Only about 3% is created by the government and the Bank of England. So this is who you are competing with now in order to buy houses in the future. And I think this actually sets a dangerous precedent. Someone should start a petition against in Parliament against this, because this is going to help to push up prices even more, because when you're bidding against a bank, they have unlimited money. They can just create it at very close to zero interest rates anyway. So it's really just not fair that you are competing with these large corporates. And all this is going to do is going to create a generation rent where the average person will be even more forced out of the affordability factor. And I just think this is morally wrong. So this should be discussed in Parliament. We should have a petition against it. But let's just look at a couple of the statistics now then. House prices have increased more than 10% this year, the highest annual growth rate seen since August 2007. August 2007, that reminds me of something. Didn't something happen in 2008? Yeah, we'll come back to that later on. But why are house prices rising so rapidly? Number one, record low interest rates. This means people have more affordability to buy a bigger house. Number two, very low stock, so very low inventory levels of houses available to purchase. So this means that the sellers can actually push up their prices because they know that there's going to be a bidding war of people trying to buy that house. So prices are being pushed up. They are not realistic right now, and this growth rate will slow in the future. Of course, this was all compounded through COVID, the mass migration, which I forecast and was accurate, QE, quantitative easing from the Bank of England, the government creating all of this new stimulus, the furlough payments, deferring debt payments, and all these other things that is market manipulation. This never ends well. This is often done in more socialist countries where you have this market manipulation. It's never been done to this extent before in the West like we're seeing in the UK. Very concerning again to me, especially with the announcement of Lloyds buying up so many houses. One thing I would love to know is if the Bank of England owns any of the housing stock in the UK. We know for a fact that roughly 27% of all the mortgages in the USA now are held by their their central banks. The Federal Reserve holds all those mortgages. So I'd be very interested to know if the Bank of England does. Very difficult to get this data. I've gone through their website, spent hours trying to get this data. Very difficult to get it. If you can get this data for me, please send it over to me, drop me a comment or send an email to the office. I would love to review that data. But it's concerning to me that maybe there's a pattern emerging here. What is the reason that these huge organizations are buying all of these mortgages, buying all of these houses? We are going to become a generation of renters if something isn't changed. A moving object tends to stay in motion. It doesn't just stop and reverse. Think of a train. Once a train gets going, it continues on the track. It doesn't just stop unless you put a big block in front of it or something like that to knock it off the tracks. So I think this is going to continue. It's a very alarming pattern that I'm seeing. One other pattern which I haven't seen many people talk about is that we actually saw a 5% reduction in mortgage approvals, or should I say houses that were bought, homes that were bought with mortgages in April 2021, 5% reduction. This has been going on month, a reduction in approvals for mortgages. So this also tells you that the lending criteria is obviously tightening a little bit because not many other fundamentals have changed. But I think a lot of people are starting to get priced out. Remember, there's always a cap on any market. There will always be a price cap. And I think we're starting to see that price cap in the UK market. I'm going to talk about the new 95% mortgages in a moment, but I just want to take you to the shared screen again and look at some more data. So here we have some house price data. This is from propertydata.co.uk. We can see the average house price for the United Kingdom and the change as well. So this is the month-on-month change. I mean, this is quite crazy, these prices now. As of March 2021, we're still waiting for a lot of the April and May data to come out. But as of March 2021, the average house price was £256,405 in the UK. £250,000 for an average house in the UK. It's just mind-blowing. And then the annual change. So we've seen up to March 2021, a 10.2% increase. We've not seen increases like this since, let's go back a little bit. In fact, it won't even show on this graph here, but the last time we saw increases like this was prior to the 2008 crisis. And then, of course, we saw what happened afterwards. If you follow this on the chart, we saw as much as a 15.6% decrease in prices there as an annual change before it started to climb back up again. Just a word of warning or guidance. A lot of people who are really concerned about a house price crash, what I would say is house prices always go back up eventually. But we are in, if you understand the fourth turning, Howells, it was a book written by Howells. I would have a study of that because for me personally, one of the biggest concerns I've got is that this current crisis that we're going into with house prices and liquidity in general, consumer credit and debt levels, it could last longer, a lot longer than the last financial crisis, which, by sort of, you can see here once we got into April 2010, we'd started to work our way out of it. I don't think it's going to be as quick the next time around. I think it could be a lot longer before we come out of the crisis. But let's continue on and see where prices have been changing the most. And let's look at the English regions. Look at Yorkshire and the Humber, the North, East and Northwest. Not sure if you saw my video from about 18 months ago or just over a year, but I actually sat down with a couple of property investors, big investors, and I talked about all of this. I said that the next boom hotspot will not be the South or the East, but it will be in the North, because this is where you've had depressed prices for such a long time. But a lot of development and investment has gone into these areas now. New transport links and more culture and things like that. that these would be places where you'll see a lot more rises than in other places, such as London, the southeast, etc. And that was actually very, very accurate if we look at this. Now, let me give you another forecast that I think, if we're talking about London, I would say over the next 6 months, maybe to a year, but I think it's going to be sooner rather than later, we're going to start to see some price reductions in the central areas of London. So this is the City of London, where we've seen the mass exodus of the banking and the finance sector. Chelsea, Kensington, some of these more wealthy areas that typically wouldn't go down dramatically in a housing market boom or even a large crash. But I think these will, because of the movement now of capital out of the City of London. So that would be a small forecast I don't mind making, and you can hold me to that in 6 months' time. Average house prices in London, you can see that these have been, here we are in 2018, July, 484,000, so 485,000. They don't look to be moving that heavily as of Feb 2021, March 2021, 500,000, 500,000 now. But again, look at this, the average house prices, just look at this trajectory that most regions are on. The southwest, so this is Cornwall and Somerset and Devonshire and places like that. Huge spike going up. But look, it's everywhere. It's everywhere, this spike. You can see this pattern. There's the Yorkshire and the Humber that we looked at. I mean, this is just outrageous, this incline. I've never seen anything like this before. The northeast, but let me tell you one thing. Often when you see climbs like this, you often see declines which may be similar on the way back down. I don't think it's going to happen the same way this time around for the northeast, because I think their prices were depressed anyway. So I don't think this crazy high trajectory is going to come down exactly the same way. I think it still will come down in the next correction, but I don't think it's going to be anywhere near as the same up and down trajectory as some of the other places, because they needed to catch up on their valuations anyway. If you're enjoying this video so far, could you do me a quick favor? Just click the like button, just helps to rank the video. Why not subscribe and leave me a comment? What do you think is going to happen to house prices over the next year or two? Now, this graph that I just want to show you here, this is from the Halifax. So this was their April 2021 house price index. And the key thing is, there's four pages of things here, but this is the key thing I want to show you. And this is known as inventory. So the number of houses available for sale on the market. And you can see where the inventory has been going over the last few years. This has been helping to push up prices. And then in April of 2020, this just dropped off a cliff. We had this huge dip, meaning that we just don't have enough supply to meet the demand on the market. And if you remember my lectures on supply and demand, whenever you have a big demand on anything but only a small supply, think antiques as an example, the prices will always go up dramatically in order to meet that demand. Now, what else will happen is that inventory then will go up eventually to meet the demand as well. And then you saw how the inventory started to pick back up, and this sort of period here, so earlier in 2021, we saw the inventory reach a high that hadn't been seen since about 2016, 2017. It's dropped back down now to meet the average, but I do think that as more homes are built in the near future, that the inventory will rise and it will level out and help house prices to plateau somewhat and be more realistic in terms of their valuations. And if you want to get a lot of the data that I read on a day-to-day basis, you don't have to, but one place I would recommend is the Nationwide. So the Nationwide House Price Index, very useful. You can get all of these sort of reports. They're quite in-depth. If you're not used to reading and analyzing huge quantities of data, it might be a little bit overwhelming, but it's very good for tracking patterns, especially if you take some of this data and you put it into some sort of an algorithm. It will show you some really nice patterns so that it helps you to forecast where we're going. However, saying that, just look at the Bank of England that said last year we'd see a 16% drop in house prices. Didn't happen. In fact, it's quite the opposite. So they were, 25% out on their forecast. And then lastly, from the screen share, I just want to show you One thing I'm seeing a lot of people talking about is that the eviction ban comes to an end on the 31st of May 2021. And this is quite crucial because a lot of us were sat here wondering if this was going to be extended again. But since this ban comes into effect tomorrow, I'm assuming that it isn't going to be extended and that they are going to allow evictions now. So what will this do? It will pull a little bit more inventory onto the market. But remember, the courts are going to be backed up for months with all of these cases. It could be 6 months, it could be 9 months, it could even be a year before a lot of this inventory comes onto the market, which will help obviously with the inventory levels. Hopefully at the same time that house builders have built a lot of houses. Maybe interest rates have gone up a little bit by then, the mortgage interest rates specifically. So a lot of these things could help to pull down the price of houses or just to stop this crazy incline that's going on. Now, I said I'd touch upon the 95% mortgages that have been announced and are now in effect through the government program. I've been very outspoken against this program for a long time. I don't think it is the right thing to do. I don't think morally it's the right thing to do. But of course, the whole premise of the campaign is that it is a moral obligation to provide these mortgages, these 95% mortgages to young people and people who may be impoverished or don't have the sort of income to afford them a house. Yes, I agree with that, but at the same time, I don't agree with it because what you're doing is you're pulling all of these people who may be struggling financially anyway into the housing market to buy a house whilst we're in the middle of a housing bubble. Therefore, people are possibly buying houses at an all-time high, which is accurate, but there could be a peak. So all these people are jumping in now, just like they were in 2006, 2007, to buy these houses. And then if there is a housing correction and prices start to go down heavily, these buyers are going to be stuck with these homes that are underwater. They're not going to be able to remortgage because you need to have the right amount of loan to value. So they're going to be stuck in these mortgages where rates are probably going to go up, mortgage rates in the future. And they're just going to be trapped. So I think morally this isn't the right thing to do. I think morally the right thing to do is to wait until houses start to normalize. The government should take action to actually normalize house prices, allow more building, let builders come in and build a lot more houses in the UK, change around some of the structure. We've got so many old blocks that are just sat there doing nothing. Turn these blocks into residential areas, maybe apartment blocks or condos or things like that. This is what's going to help people to get on the housing ladder. A lot of young people these days anyway, they don't want these big houses. They couldn't afford them if they could. What they want are these new places. So here's an example where I am right now. This is an apartment complex, big apartment, 3 bedrooms, really nice, 3 bed, 3 bathrooms. Downstairs there is a gymnasium, there is a really long swimming pool and all this sort of stuff. You've got yoga and whatever. You've got a work area and space. Like there's all this stuff here which young people love. Most of the people here are very young. And this is what is appealing to a lot of people now. As long as you've got high-speed Wi-Fi, high-speed broadband, this is a great opportunity for a lot of people. So this is what we should be seeing more of. Combined, yes, okay, with smaller houses and building some of the bigger houses. But personally, I think we've got enough of the big houses. We need to get more people onto the housing ladder, not this generation rent mentality that's going on. This is what we need to move towards. So I mentioned the tenant eviction ban. I want to talk about a few other points that I brought up on my video maybe 6 months or so ago. So one of them was the sort of impact that all of these programs would have if they all ended at the same time. Of course, they're not ending at the same time now, as we know. So the tenant eviction ban, 31st of May 2021, I think this will have a small impact on the housing market, but not for a while yet. Stamp duty ending, 30th of June 2021. I said they would extend it, they did. This will have a medium-term impact. I do believe it will have a medium-term impact on house prices because a lot of people will be rushing through their purchases now in order to avoid that extra stamp duty. The furlough ends. So the furlough program is due to end on the 31st of September. I personally think it will end this time around. The reason I do think the furlough will end on the 31st September is because of the recovery, although I don't really think it is a recovery. I think it's a false recovery fueled by liquidity and quantitative easing, but that's by the by. But the furlough, I do think, will end on the 31st of September. And I'll just show you the tiers here. So June will be 80% of the wages paid by the government, so the employer only has to pay 20%. July, the government will pay 70%. August and September, the government will cover 60%. I personally feel that this will create a new unemployment wave once we get into October, but I think it will start a little bit earlier once employers have to pick up this extra 10-20% from July time. So I do think that will have a medium-term impact as well. And then, of course, we have the mortgage payment holidays, which are various in their duration. I don't think this is going to have a huge impact like a lot of people are talking about, simply because of how it's staggered in terms of end dates. And, of course, evicting someone from their home is going to be quite difficult. There's going to be a backlog. I think a lot of the banks and people are going to work out arrangements. So maybe add all of the debt that wasn't paid to the end of the loan. Maybe there might be some adjustments with interest rates and things like that. I think that's a lot more likely to happen. I don't think it's going to affect house prices the way a lot of people think so. And then finally then, I want to talk about mass migration patterns. I forecast this very accurately for the United States market. I didn't really make a big forecast on the UK market, other than I said that I believe a lot of people start leaving the big cities. So like I mentioned, City of London, London regions, some of the bigger cities, and especially in the inner city, I said that a lot of people would start to move. That trend actually has been occurring now. I do think as well we're going to see a lot more movement to areas that maybe haven't seen growth in recent years. Of course, we've seen the north, and I explained that already. But another one to watch out for is I think we're going to see a lot of people start moving from England over to Wales. Now, I know some of the Welsh that are watching this are probably going to be going, no, Neil, we don't want any English in Wales, which is what they always seem to say to me. But I do think, unfortunately, whether you like it or not, we're going to see a lot more movement of the English into Wales. We're already seeing a little bit of that going on now, but I do think that we're going to see a lot more of it over the next year or two as people realize that they've been priced out of some of the markets they want to buy in, and they're going to start moving further out. And if you're wondering what type of houses as well, I think it's going to be larger houses, so people are going to go for more space with gardens and lots of outdoor space, a little bit more nature around them, while still having those same facilities that they are used to. These are the patterns I think you should look out for. But just a warning for any of you, so maybe you've just bought a home or you're looking to buy a home, maybe you're an investor, a landlord looking to buy a house or two. My guidance would be this, and this is something I learned the hard way during the 2008 crisis. The banks are not your friends, okay? They'll pretend to be your friends and give you these low rates, fixed 3-year deals and all this sort of thing. My personal belief is that in 3, 4, 5-year time, whenever your fixed rate ends, I don't believe that mortgage rates will be as low as they are now. I think they'll be a lot higher than they are. So just make sure to stress test your mortgage rate. What do I mean by this? Let's say that you've got a 3%, 4% fixed rate right now. I would stress test this to maybe 5, 6, 7, even 8% over the coming years. Maybe in 5 years' time, you might want to stress test it to as much as 7 or 8%, and see what your payments would be then. See if it's still affordable. What happens if your house falls in value? Could you refinance? Because that's actually one of the things that happened to me in the crisis. My home value fell because I bought some of these houses just before the crash. Yeah. And my interest rate, by the time that the rate came around again to renew, was 3-4 points higher. And I was paying an absolute fortune. My house was underwater so that I couldn't even revalue it. Underwater is a term for negative equity. So I couldn't even get a refinancing deal. I couldn't remortgage my house. It put me in a very bad situation. And all of those brokers and the banks and everyone who had lent me money, back then, when I went to see them again for help, they all just closed their doors. They weren't interested. You've got to remember, never forget, the banks are not your friends. Be smart about this. Really stress test the rates and your affordability, and don't just buy into the fear. Okay, there's two things going on right now. It is a psychological market. It is fear and greed. I don't know which side you're on, but if you're on the side of you're just afraid because you're going to get priced out of the market, so you're buying right now, personally, it's not something I would do. I'm not buying myself. But what will happen to prices in 5 years' time? No one knows. It's too far out to forecast. Just look at how most experts forecast 1 year, just 12 months, right? That should be fairly simple. And most people got it wrong. Most of the top experts are getting things wrong at every turn because everyone's basing it on historical data, which doesn't apply in what's going on right now. It's just, we're living in crazy times. I don't think this is over. I think we're going to see a lot more uncertainty, a lot more craziness in all of the markets, actually, not just the housing market, but all of the financial markets. I don't think we're going to be going into good times in the near future. Just make sure that you batten down the hatches, prepare as best you can. But apart from that, thanks for watching today. God bless. See you all next time. Please click the like button, subscribe if you haven't already, and I'll see you soon.